Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This is going to be another video on the SP 500 covering what's going on this move, what we can expect in the next few weeks, in the next few months. There are way too many things to cover on the stock market, way too many things to highlight. A lot of the work and the research that we've put together just over the past few months has finally seems to be playing out. So before we take a look at that in detail and see what's going on with oil, what's going on with CPI and how we can expect that, how that's been influencing the market, and how we can expect these factors to impact the SP 500 for the foreseeable future. Those are the questions we're going to be answering in this video. But before we do that, I always like to take a look at a longer term chart to really give you guys the broader context, a broader macro view of what we expect looking out 5 to 10 years, because there's quite a few reasons to be pretty pessimistic on the market looking out 10 years, right? And this is something that you evidently see online, on YouTube, on Twitter. So many people have a bearish bias on the market. And one of the big reasons for that is because valuation. So let's say PE ratios, or another valuation metric that we like to use is earnings yield. They're very, very overextended. Ever since 2009, we've been in this incredible bull run that's been fueled by low rates, low interest rates, low bond yields, and low inflation. That's what's been fueling essentially what a lot of people call an asset bubble. And so it's been this incredible environment to be in the stock market throughout the last 10, 15 years, but this has led to an extreme long-term overvaluation of the market. And this is just one of those charts that highlights this concept. And it shows you the 10-year changes in the 10-year treasury yield against earnings yield, which is basically valuation. And so when earnings yields are very low, it means the market is very expensive. And when the earnings yields are very high, it means the market is very cheap, or it's getting cheaper. And so what this chart essentially shows you, and we don't have to get into the actual details, but it shows you that as you see an increase in the 10-year, you see valuations getting cheaper. And when you see decreases in the 10-year yield, valuations get more expensive. Now, we know that earnings yields right now are extremely unattractive. Long-term valuations don't look attractive. They're at the same levels as around 2000, making the stock market extremely vulnerable to a longer-term uptrend in yields. If we see this long-term downtrend that we've had on the 10-year treasury yield that we've had really since 1982. We've seen yields trend down steadily for the past 40 years and leading to higher and higher valuations on the market. If all of a sudden you see this bottom out and then eventually trigger longer term uptrend in yields, similar to something that we saw throughout the 1970s, that would be a stock market killer. And you could actually see what that would look like. It would basically be a sideways market for the next 10 years. So that's the type of market environment that long-term investors want to avoid. But of course, we can't use these types of charts, longer-term charts, to tell us what is going to be happening now. Because that's what our goal is at Game of Trade. We want to understand what the market is going to do looking out 6 to 12 months. That's the time frame in which most of the big moves can be captured, right? Let's say this big move was around a year, then this moved down in 2011, that was around 6 months. This moved down in 2015, that was around a year. All of these big trends in the market are usually represented by the 6 to 12 month time frame. So that's what our focus is. And if you've been listening to what our research has been saying throughout the past few months, we've actually been making the case for the market to rise violently over the next few months. Our bullish thesis is based on peak inflation and peak yields, and that remains the case today. This chart highlighting the change in the price of the motor fuel CPI component. And you can see this is from an article that was posted on the 6th of June. So just before oil made its big peak right here on the 10th of June. And you could clearly see on this chart that even going back to the 1960s, 70s, where you had the oil shock, what we saw throughout 2021 and 2022 was unparalleled in terms of the magnitude of how much that contributed to inflation. And so there was a lot less runway for oil to continue rising. We also highlighted the fact that the Ukraine-Russia war was entirely priced into the price of oil. So this was a sell the news event. It was completely priced in relative to 10 episodes that were the most similar in terms of the war risk index. Now, why am I saying this? Because this actually still very much applies today, and this is a chart that highlights that. I think it's important to remind some of these research pieces that we put together leading up to the bottom in the market, because you can clearly see on this chart, this is the SP 500 before and after inflation peaks, and you can see the SP 500 goes down before an inflation peaks, right, a year leading into the inflation peak. Then it bottoms just before the peak in inflation, which is highlighted with this vertical line here. And then following the inflation peak, the market goes out on a massive run. Even 12 months out here, if we try to spot where we are on this chart, we haven't even seen the inflation peak yet. We're right here. We're at around the 0 mark here. June CPI was extremely hot at 9.1%. And look at what the stock market did if we put inflation on top of the S&P 500. The market bottomed just before we got that CPI reading. And we do think that inflation is going to move lower in the next few months. So the market still has quite a big wall of worry to climb. And what do I mean by that? I can show you this chart of the put-call ratio. And this is one of the indicators that we like to use to illustrate the pessimism or the optimism in the market. And the put-call ratio is basically the number of puts divided by the number of calls. So if it's extremely elevated, it means there's a lot of pessimism, a lot of people betting on the downside for the market. And what we essentially did on this chart, and I'm going to zoom out here so you can see very clearly, is we put the put-call ratio, this is a 50-day moving average of the put-call ratio, against the S&P 500, and you can see every time this ratio reaches 1, we put a vertical line here. And you can see what that corresponds to every time on the stock market. This was April 2020, right after the bottom in 2020. This was 2018, as the market was bottoming. This was 2015, major buying opportunity. Unfortunately, this chart doesn't seem to be loading, but you have several examples of bottoms occurring right as the pessimism was hitting an extreme level. And this is something we highlighted right here, I believe on the 21st of June of 2022. And in this article, severe pessimism suggests that stocks are about to climb the wall of worry. And so far you can see, press on that play button, that's what the market has been doing. And you can see recoveries off these types of extremely pessimistic market environments can be very violent, and it often doesn't let investors get back into the market. You often don't see very much pullback or nowhere enough to let investors get back into the market. And this is why it's imperative to be averaging down into the pessimism. This is what our strategy is really based around in the market, is we want to take advantage of those discounts. We want to take advantage of that fear so that we can profit from all the good things that happen from enduring that pain. Now, does that mean that the market can't come back here in this zone? Absolutely not. Of course it can come back to these levels, and we've highlighted that many times. I don't remember the exact support levels, but around this zone here, we don't have a crystal ball. We don't want to predict what's going to happen. We want to capture the larger moves in the market, regardless of what happens in the short term, whether that's a V-shaped recovery or a bottoming process where we could even retest that low before moving higher. It's all about risk reward, nothing about predicting the exact moves of the market. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to click on that like button. If you are new here, make sure to smash that subscribe button. In the meantime, I wish you good luck on your trading, and see you next time.